finding an edge right now, I think for most investors who aren't willing to go nuts on the direct to seller side, really requires you to vertically integrate services, like management, construction, be an unbelievable operator, control your management, or work with a third party that is extremely forward thinking from a tech standpoint and is ahead of all of these trends, or you need to really nail the financing or capital structure side, where you need to raise capital at a lower cost of capital than your competition. What's going on, everybody? Welcome back to another quick solo episode here on the Multifamily Wealth Podcast. And this episode, I want to touch on a trend that I'm just witnessing in real time, and I think many investors are witnessing in real time, which is the reshaping of the small multifamily market, really the small multifamily segment of the overall multifamily real estate market. And what that means for the small multifamily investors out there, of which I know many listen to this podcast. All right, guys. So in this episode, I just want to have an open conversation around a trend that I'm seeing. And I think it's a really interesting one. And I think it's starting to really dictate how we pursue deals in our business, which, as many of you know, we pursue small to mid-sized multifamily deals. This topic is fresh in mind for me because we just spent about 45, 60 days raising the first round of our New Hampshire Multifamily Fund, titled New Hampshire Multifamily Fund 3, which is a fund that we raised capital for to pursue small to mid-sized deals in New Hampshire, which has really been our special sauce, our bread and butter over the last really 9 years, 8 years. I mean, since I started investing in multifamily. And we do a whole bunch of direct to seller marketing and prospecting. We do a high volume of these deals, 10 to 15 a year on average over the last handful of years. And this is just a trend that I've noticed and something that I think is an interesting podcast topic, or just an interesting topic to discuss, I should say, because in my opinion, over the next 3 to 5 years, this trend is only going to continue to accelerate. And for the investors out there that are either A, newer, or B, spending a lot of time looking for these types of deals right now, or maybe this is your core focus, you should really keep this trend in mind because frankly, I think it's just going to be harder to buy the deals that we pursue. And I think it makes a lot of sense to pour gas on a fire right now that is still kind of roaring. I shouldn't say roaring, but it's still, alive or in flames versus one that's going to get a little bit more challenging to stoke into the future. And that might be a pretty bootlegged and shitty analogy, but I think I'm somewhat getting my point across there. And the trend that I'm talking about here, to just cut to the chase, is the continued financialization of smaller multifamily assets. Put in a simpler way, the continued increase in competition as we pursue small multifamily properties. And there's a handful of reasons for this. And I actually wrote an email to our email list about this recently. This is a topic that I continue to discuss with potential LPs and the LPs that converted into investors in our New Hampshire Multifamily Fund, to create some sense of urgency around the strategy and what we're doing. And when I say continued financialization, continued competition, it's basically that the small multifamily segment of the marketplace is becoming more efficiently traded than it ever has before, at least since I've been in the market. And I got into the market at a time when, the market was less efficient. And so folks I chat with who have been in the game for longer than I have echo my sentiments and my thoughts here. But basically, what I'm communicating here is that there is an increase in larger, sophisticated investors in the smaller segments of the marketplace. This didn't used to be the case, right? I think for the entirety of time that real estate is transacted, there has been a very fragmented investor base or set of investors that have pursued, call it 2 to 20, 30 unit properties. And we'll just speak generally, right? I mean, in big markets like a Boston or New York or in LA or whatever, 30 unit properties, 20 unit properties, those are going to be pursued by really sophisticated folks because those are $10, $20 million deals. I don't know, whatever it might be. But for the vast majority of the markets across the country, these deals have been pursued by individuals, by, let's just very broadly categorize them as unsophisticated or non-sophisticated investors. And every once in a while, you get a handful of smart groups, smart investors who put together a number of these properties into a portfolio and they buy 60, 80, 100 units comprised of 4 to 10 unit properties over the course of a career. And they operate them really well. But they're not like private equity groups. They're not large groups. And I think what we're seeing now is a lot of these smaller properties are being more heavily pursued by the sophisticated investors, those who are raising capital, those who are coming downstream instead of going upstream, right? They're coming down from the 80, 100, 200 unit deals and buying these smaller assets. And it's for a handful of different reasons. The first reason that I'm going to mention kind of really three big ones here. But the first one is that the knowledge has been completely democratized in terms of how to be a real estate investor. And now this doesn't explain why a larger investor would come downstream and pursue a smaller deal, but this just speaks to the continued efficiency gains or the continued financialization of these smaller deals, where it's becoming a more efficiently traded market, just broadly speaking, because first-time investors are not coming in with a lack of knowledge of how to be a real estate owner or a, property manager or a real estate investor. There are so many resources available. Bigger Pockets, YouTube, networking groups, online courses, just, podcasts, everything. There are so many resources available to a new investor to at least just give them some baseline of knowledge as to how to operate a building. And if they don't have it when they get into the business and they buy a duplex and maybe they buy another one, they're certainly going to arrive at some level of this training at some point. And it's starting to level the playing field in terms of how you operate multifamily real estate or real estate in general. That didn't used to be the case, even just like 10 years ago. Let's go back to 2015. I bought my first deal in 2016. I wasn't really extremely active until 18, 19, but 2016 was the first deal that I did. And even then, I had like the Bigger Pockets podcast. That was kind of it. There was like another couple of YouTube channels, but it wasn't really like a ton. And it was still enough to get on there and be like, all right, this is how you, set up a LLC, and this is how you buy a place, and this is how you want to speak with your tenants. Like, it was very basic. Fast forward 10 years, there's 1,000x in terms of the content and books and online courses and podcasts and what have you. If we were to go back into like even before 2015, like early 2010s, there really wasn't any of this. Like Bigger Pockets was the one online resource that really started to reshape. But it was like bootlegged weekend seminars on how to be a real estate investor. We had to go spend $2,500 ripped off by some guy in a conference room at a Hilton. And that's how you learned real estate outside of just asking people who already owned it. So you had this insanely fragmented set of investors from a knowledge standpoint. Some were really good, some didn't know anything, some were in the middle, but it was kind of all over the place. And the market wasn't efficiently traded as a result of that. Somebody's renting for this price, someone's renting at that price. The other piece of this is there was so much more information asymmetry or lack of information all the way up until a handful of years ago. Now there are so many resources, whether it's the expensive ones like CoStar, the cheap ones like Rentometer, or, we have all of the rental websites so people can go on and pull rent comps, sales comps real quickly. And for a long time, it was just easier to find a completely mispriced property or buy a property from someone who thought the market rents were $1,000 when in reality they're $1,500. And now that's not really the case. Like everyone just has way more information as well. It's really hard to like misprice a unit when you go to lease it. That doesn't really happen at all anymore. Even if you're like the guy who's got a 3-unit property, like pull up Zillow, you got a whole bunch of comps right in front of you. You pull up Rentometer, you're going to get a sense of where your property price should be for a lease. So there's way more information, and then the knowledge base has become significantly higher amongst these investors, which has continued to democratize, just all of the information and knowledge basically to be repetitive, which means that most folks are playing on the same playing field. They're much more so than they previously had, and that's leading to deals being more efficiently traded. The second thing, and this is really one of the big reasons why many smarter, call it quote unquote smarter, more experienced, sophisticated investors didn't like to buy small multifamily properties. And that's because the property management is much more challenging. It's so much harder to manage 10 unit buildings than 100-unit building. You can put an on-site manager at the 100-unit building, quality management increases. 10-unit buildings, all right, that's much harder. You have to have a PM that runs around to each of them, and there's not enough scale for on-site staff, etc. That's always been the big knock. And that's true. It's always been harder to manage from a property management standpoint, scattered site buildings. It's a lot more work. Your cost of management is typically higher. It's a little bit more unpredictable in terms of just being able to project consistent results. But what's happening now is technology is starting to smooth that over a little bit. It's starting to reduce the gap from a headache and challenges standpoint between small multifamily, large multifamily. And there's a whole slew of different examples of this. remote showings on the leasing side, AI conversations on the, resident inquiry side, resources like Property Meld or Smart Maintenance with Appfolio for maintenance, right? Having some level of a conversation with a resident before you dispatch a tech. All kinds of things from like an automation process, whether it's software specifically built for property management automations or whether it's within the big property management softwares like Appfolio, Propertyware, whatever, that automate a lot of the back end tasks a little bit more. Leveraging offshore talent to do everything that doesn't require someone to be in front of someone at a property. So the cost of scattered site management is coming down. It doesn't necessarily mean it's easier. I mean, it is a little easier, but it still is more expensive. It's still harder. But the cost is coming down. And as the cost comes down, we continue to, again, close the gap from a pricing standpoint and the quality of average participant in that marketplace. The last thing is that the boomer generation is exiting and selling to educated investors. And we are now transitioning from a generation of real estate ownership that doesn't care about all the resources we're talking about, that still keeps the rent rolls on a piece of paper, that doesn't really leverage, if they have a property management software, they're not using it really well. And this is specifically for the small owners. They're selling their 5, 10, 15, 20 unit buildings to folks who are 25 to 40 years old that grew up on technology, that have all of these resources available at their fingertips, that are turning it over and efficiently operating them. And again, this is a life cycle. I would imagine that there's probably someone who's listening to this who's 60 years old and is like, yeah, I would have defined myself in the same way back in the early 2000s or mid 2000s or whatever, 2005 when I bought this property 20 years ago from the guy who was also older. And that's true, but there hasn't been the rate of change from a property management standpoint and from a data availability standpoint from the 80s, 90s into the 2000s as there has over the last 10, 15, 20 years, and really over the last 5 years. Like, you can underwrite a piece of real estate now by just uploading the data to ChatGPT and it'll tell you. Like, it sounds stupid, but that's really, you can do that. That's literally technology that we now have. You can generate a lease agreement that's compliant to your state on ChatGPT. Like, you have all of these resources. It's like so hard to be bad at this now. If you're not good at owning multifamily or owning a real estate or a piece of real estate, like, you are completely ignorant and out of touch. It is so easy to be good at this because of how much information is available. That, as again, going back to point number one, where knowledge has been completely democratized, it's all of these boomers are selling properties to people that are good at it, even if they haven't even done a deal yet. And that just means, again, the market's becoming much more efficiently traded, right? I mean, the bid ask, or I shouldn't say the bid ask spread, but the bids between different buyers is becoming so much more tight. The asking price for assets is becoming so much tighter when brokers list. There's just less mispricings, less inefficiency. So all of this as a developing trend, like, what does this mean for multifamily investors right now, specifically the ones that are looking at smaller deals? It's that finding an edge right now in small multifamily where, at least in, let's just define this to my time in the business, 2016 to today. 2016 to 2022, like, send some mail, buy some great deals. Like, it was really easy to find an edge, frankly. And we still are developing an edge on our direct to seller side because we do it at a high level and we do it consistently. But finding an edge right now, I think for most investors who aren't willing to go nuts on the direct to seller side, really requires you to vertically integrate services, like management, construction, be an unbelievable operator, control your management, or work with a third party that is extremely forward thinking from a tech standpoint and is ahead of all of these trends. Or you need to really nail the financing or capital structure side, where you need to source debt at a really low rate, at a lower rate than your competition. You need to raise capital at a lower cost of capital than your competition, right? Where it's like, okay, if you are going to pay the same because it's getting a little bit more tightly bid and you're, kind of doing okay on the management side or good, you're not creating an advantage there, well, then you're going to nail the capital structure side. And you have to be extremely diligent on mitigating costs, mitigating your financing costs, mitigating your closing costs, like creating edge during the transaction and then throughout the hold period from a financing capital structure standpoint. Ours is, we like to think we're doing a great job on the management side because we control that. We think we're a great PM, for all of our third-party PM clients as well. And then we're buying great deals and we want to, again, we like to think we're doing a good job on the capital structure side. So we're trying to find edge in a few different places. But the edge of I wait for the mispriced deal or I send a couple rounds of mail a year, I hire my third party PM, I use market rate debt, it's starting to go away. You have to start working a little bit harder than that, long story short. And the other piece of this too is this is only a trend that will continue. There's no reverting this back to some period of time where more people are bad at doing this or where technology starts to revert and it doesn't help us manage more efficiently. Or we have more unsophisticated older owners. Like, no, the boomer generation's dying off, right? They're selling out, they're retiring. Vast majority of the deals that we buy are from people who are in their late 60s to early 80s. Like, that's typically our seller profile. So understand that the window to take advantage of this is closing. And this is like part of our pitch to a lot of the people who invested in the New Hampshire Multifamily Fund. It's like, this is a trend that is going to continue to die. I shouldn't say trend that's going to continue to die. It's a trend that's going to continue to grow. The opportunity is going to continue to die. Not that it'll completely die off, but it's going to become less apparent, less available. Like, might as well take advantage of this right now and invest in what we're doing so that we can really leverage the edges that we've created, particularly in this market, and continue buying these deals at good pricing, operating them well, and staying ahead of what the competition's doing. You know, it's my prediction that in 5, 7, 10 years, probably closer to 5 years, like there's going to be very little edge in any aspect of real estate investing, period. When you think about how efficiently traded the large multifamily market is right now, 100 plus units, it's really hard to find edge there. It's really hard to find like a discounted deal fundamentally. It's really hard to operate better than the competition. It's really hard to finance them more effectively because everyone's aware of what the financing options are. So knowing that, and that's why a lot of the people who buy large multifamily, it's basically just levered bets on a macroeconomic area. You're basically banking on market growth. Yeah, you can execute well, you can out execute. Of course, there's still going to be advantages to the people that operate really well. I certainly don't want to say that that's not the case because there really are. You can still do a better job operationally. But the gap between a great operator and an average operator is tighter now than it was 3 years ago, 5 years ago, 8 years ago, way, way tighter than it was 15 years ago. And that's me. I wasn't in the market then, but that's based on what everyone who I've talked to who was says. So there's a sense of urgency around getting it while the getting's good that we feel in our business. And for some reason, I felt like that was compelling to share, right? I think I think it's important to mention for the new investors, like that'll help you get off your butt and get rolling, I would imagine. For the LPs who are like, yeah, it's kind of a good point. We've got a fund for you, and I'll shamelessly plug it, like the New Hampshire Multifamily Fund. If you want to participate in what we're doing, I'll link it in the show notes, and you can jump into the deal room, download our deck, learn a little bit more about it. And then for like the operators out there who have an existing portfolio, it's a good time to try to lean on, or I should say not lean on, but really develop what your special sauce is. Like, what are you good at? And I don't think many investors just look in the mirror enough and just ask themselves that question for those who are like trying to meaningfully grow. If you're like, I want to buy a duplex every year for the next 10 years, like it's a 20 units, I'm going to pay them off and that's my retirement. Cool. I don't have many notes for you. Like you can just do that without finding an edge. If you're someone who wants to like, grow a real estate business, you need to figure out what your edge is. Like, what are you good at? Most people don't even know what they're good at. Like in our business, we're good at finding good deals, like very confident in defining that. I think we're borderline great at that. I think we're good to great on the operational side. I think we're solid on the capital structure side. I wouldn't define that as like a massive edge for us. Just speaking plainly, I think that's just, you know, I wouldn't say that like we're better at that than everyone we compete with. On the deal side, I would say that we're better than that at the vast majority of people we're competing with. But at least we've defined what that edge is in our business. Most investors have no idea what it is. And if you're trying to actually actively grow your portfolio in a real scalable fashion, you need to define that. Am I going to spend all of my time building the most kick-ass operational infrastructure with in-house PM, in-house construction, and then I can pay a little bit more for deals knowing that I can renovate lower and operate more efficiently? Good, you've defined that. Are you not going to do that? Okay, well, you better take the time you would normally dedicate to that and pour it into finding great deals. If you're not good at either of those things, well, cultivate a network of folks who are willing to invest in your deals at a lower projected return so you can create more arbitrage on the capital side. Anyways, figure out what your edge is, lean on it because it's going to get harder to find good deals in this segment of the marketplace. And I think that's fundamentally the thesis of this episode. So again, I hope you all appreciate, or I hope you all learned something. One, and two, appreciate the show. And if you do, please consider leaving the show a rating and review. Would love to get to 300 ratings soon, on iTunes at least. If you haven't left one and you've learned anything here, I don't even think it takes you 5 seconds. It might take you 3 seconds to just hit bang 5 stars, but it helps the show get noticed by more people. So I would appreciate it for all those that do it. And if you're interested in learning more about the fund, click the link in the show notes. We'll link to the deal room down there. And feel free to review the deck, reach out to me, schedule a call if you'd like to learn more about what we're working on that front. But again, appreciate you all for listening, and we'll chat next week.